An increasing number of people are worrying how they will maintain their standard of living in old age, especially if they are still laden down with mortgage debt. Household bills and day-to-day costs continue to rise, while savings rates remain poor and pensions less generous. In total, housing wealth among the retired stands at more than £1.1 trillion. Some of this wealth, says Key, could be used to provide an all-important boost to household finances. There are two ways to release equity, either by downsizing or taking out an equity release mortgage on the family home with interest charges rolling up. Equity release plans, or lifetime mortgages as they are sometimes known, are more flexible and better value than ever before. Here are 8 key facts you may not know about these plans. Most equity release providers will allow you to take out a plan if you have an existing mortgage, provided you use the plan's proceeds or any other savings to pay it off. A big proportion of equity release plans are arranged for this very purpose. Tom Moloney, equity release advisor at H Partnership, says a quarter of all equity release plans he arranges are to pay off existing mortgage debt. This is typically where the borrower has had an interest-only loan but has no savings to pay off the capital at the end of its term. He says, releasing equity can be a lifeline where there is mortgage debt to clear and the homeowner has no desire to up sticks and downsize. You can release cash in stages. Often with equity release, the borrower has an immediate need for funds to pay off debts or to fund much-needed home improvements. But now you can often choose to pay all or part of the monthly interest charges on your lifetime mortgage. Some homeowners opt to do this as it stops the outstanding debt growing too quickly. It means the amount owed will be less when the property is finally sold and the equity release plan comes to an end. Plans are typically flexible, enabling borrowers to stop interest payments at any time and convert to a standard lifetime mortgage, with interest rolling up and paid at the plan's term. Existing medical conditions, poor health or lifestyle factors, such as a history of smoking, usually mean higher costs for many financial products, particularly insurance. But with an equity release plan it works the opposite way. The poorer your health, the bigger the lump sum you will be able to extract from your loan. This is because your life expectancy will be considered lower than someone in robust good health. Serious medical conditions including cancer, stroke, diabetes, heart disease and even high blood pressure could mean you were able to release more equity from your home. 5. You can switch, but watch for charges depending on the type of equity release plan you have. It is not usually difficult to switch providers, for example to get a lower interest rate on your loan. Always read the small print and be aware of all charges before you sign up to a specific plan. All equity release plans offered by members of trade body the Equity Release Council have a no negative equity guarantee. This means that even if the value of your property falls, you will never owe, in capital loan and interest, more than its final sale value. This guarantee ensures borrowers have peace of mind that they have the right to remain in their home as long as they choose. There will also be no unexpected debt for family to deal with when their parents die. 7. Ring-fence some of the value for inheritance. Some homeowners shun equity release because they want to be able to pass on a legacy to children and grandchildren. But it is possible to protect a proportion of a property's value, even when you take out a plan. Andrea Rosario, Chief Corporate Officer at Equity Release Advisor Bauer Retirement, says, if passing on an inheritance is a priority, it is important to look at protected equity products. Plans are portable. When you have equity release plans are portable and can be moved to a new property as long as it provides suitable security to the lender. A park home, for example, may not be acceptable. Dean Murphin is Chief Product Officer at Equity Release Advisor Key Retirement. He says, many plans now offer downsizing protection. This allows the borrower, after 5 years of having the plan, to use the proceeds of their house sale to clear the loan without paying early repayment charges. If this is something you think you may need in the future, it is important to discuss it with your advisor and get this protection at the outset.